Let's look at an example. Say that you sell goods for $10,000 at the beginning of the first quarter and the receivable is due in 180 days. You record the sale and the receivable at the undiscounted amount of $10,000 and you estimate that the expected credit loss is 2% or $200. For simplicity, let's ignore the cost of sales. Under IFRS 9, your income statement would show revenue of $10,000, a provision of $200, resulting in net income of $9,800. Think about that for a second. Even though you haven't lost a penny yet, you have to record a loss. Remember at the beginning of this series when I told you that sometimes things wouldn't make sense and it was important to have the context for what the board was trying to accomplish? Here's a perfect example. Really, the IASB wanted to get bigger losses on the books of financial institutions earlier on, since that's what everybody complained about during the financial crisis. And so, here we are. Going back to our example, at the end of Q1, let's say you reassess the credit status of the receivable and whether the likelihood of a loss has changed. For instance, you might find that you have an impairment gain of $100. That's a pretty new concept for us. We're all used to having provisions that stay fairly steady over time, and we usually don't end up with significant reversals. Now, each period, we could end up with an impairment gain or loss. In fact, the likelihood of default might change simply because of things like macroeconomic conditions, which might drive increases or decreases as we move throughout the economic cycle. Let's say that in Q2, the receivable actually pays off in full. At that point, you'd recognize the remaining reversal of $100 through the income statement. Our example is a simple one, and the calculation of expected losses can be much more complicated. For example, strictly speaking, IFRS 9 requires you to consider losses that would arise in a number of different scenarios and then apply a probability-weighted average to them. Things can get messy and complicated in a real hurry, and even the most sophisticated financial institutions have challenges in implementing IFRS 9 for this very reason. Don't worry though, there are some simplifications that you can apply, and we'll talk about those next.